Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Meta Platforms in talks to spend billions on Google's AI chip, suggesting that the search giant Google has made the case that it can rival Nvidia as a leader in artificial intelligence technology. Let's check in with an expert who's got an opinion there. Mandeep Singh, senior tech analyst for Bloomberg Intelligence. Mandeep, what do you make of this news with Meta investing and spending money on Google's AI chips? What does that mean for the space and Nvidia in particular? Because we're seeing some big moves in the stock market today.
Look, I mean, we know CapEx numbers are going up, not just next year, probably through 2028, because Meta has given some sort of a 3-year forecast. In fact, Mark Zuckerberg has mentioned that, they plan to spend up to $600 billion in CapEx through 2028. So when you are spending such big sums, you don't want to be dependent on one supplier. And in this case, Nvidia still has the best chips. They probably have a virtual monopoly when it comes to the training. But on the inferencing side, I think everyone, especially among the hyperscalers who don't have their own chips, are looking to diversify. And I think I'm very surprised that Meta is looking to buy something from Google, given they compete, so fiercely on the digital ad side. But that's really a reflection of the changing tech stack and how these companies are evolving with AI.
What is it about Alphabet and Google that we did not realize that they're making so much progress on their own chips, these TPUs, tensor processing units? It does feel like it's kind of come from out of nowhere. I know folks in the tech industry know that Google has been working on this for a while, but if you were just following along, it feels like NVIDIA had this locked up and then all of a sudden it's a little bit more open.
Yeah, I mean, Google is in the 7th generation of their TPUs. So clearly they have been working at this for a while, which is the reason why the TPU has been able to catch up to NVIDIA's GPU in terms of performance. But to your point, look, the Gemini model was not comparable to OpenAI and Anthropic's leading models up until the last 6 months. So that is what has changed, that Gemini as a standalone model has been able to match up to, OpenAI, whether it's in terms of chatbot functionality, image generation, video generation. They are a state-of-the-art model. Maybe in terms of coding agent, they still trail Anthropic. So Anthropic released a new version yesterday, and they still claim that their models are better than Gemini. But if you are looking for a state-of-the-art model at the lowest cost in terms of tokens, Gemini is your best bet, and which is what Meta is realizing, that yes, they could use the low cost that Google has in terms of running their infrastructure and use it to their advantage in terms of how they are looking to deploy Gen AI on their family of apps.
So, Mandeep, can you give us a sense of the competitive landscape today for NVIDIA? We know, I guess now we have a better appreciation for Google as a competitor.
Yeah.
Just lay it out for us and how you think it might play out.
I mean, the one metric that NVIDIA shared on their latest earnings call was their content per gigawatt is going to grow over the next few years. And the reason they said is because they generate the most tokens per watt. Now, for 1 gigawatt, Jensen said they'll have up to $30 to $35 billion of NVIDIA chips being purchased. Think about it, if a 1 gigawatt costs $50 billion, any company spending 30 to 35 billion, and all these companies like OpenAI has talked about adding up to 26 gigawatts in capacity. That really translates into huge revenue for NVIDIA just from one hyperscaler. And that's what I think Meta, if they plan to add 10 gigawatts over the next 5 years, they don't want to be giving NVIDIA, $300 billion just for the chips. They want to diversify and really make sure they're running their infrastructure at the lowest cost, which is what Google is doing. Google spent $90 billion in CapEx this year. And guess what? They have a cloud business. They have trained their new model. They're doing inferencing at scale. They're serving search and all their family of apps with Gen AI functionality. So they are really running it very efficiently. They're not spending to $30 to $35 billion per gigawatt. And that's what everyone is seeing now in terms of efficiency.
So you do a great job of explaining this from a technical point of view, from the technology's point of view. But for investors who really just understand NVIDIA as, AI personified or embodied, is this just an opportunity to diversify and not rely so much on NVIDIA and maybe chase another company whose shares have not rallied as much?
I think so. I mean, it's very hard to see multiple expansion in a company like NVIDIA, which was close to, 4 trillion plus. And I think they're growing very nicely into earnings. They've given a forecast of up to $330 billion in revenue next year. So there is embedded growth in there. But everyone has that scars from, the dot-com bubble in terms of paying too much in terms of multiple. And that's where you're seeing people really being conservative in terms of what sort of multiple they pay for a stock like NVIDIA.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's talk some retailers. We got some retailers bringing up the rear of earnings season as they like to do. We had Dick's Sporting Goods and we had Best Buy. And let's break it all down with Lindsay Dutch, Consumer Hardlines Senior Analyst for Bloomberg Intelligence, joining us from Princeton via that Zoom thing. Let's start with Dick's Sporting Goods. They raised their outlook again, but I guess investors are focused on, some of the costs trying to turn around Foot Locker. Talk to us about Dick's Sporting Goods, Lindsay.
Yes, that's right. The legacy business remained very strong in the third quarter, strong back to school, clear demand momentum heading into the fourth quarter. And that's where the raised outlook came. It was really for the legacy business. But when we look at Foot Locker, the deal closed early September. The outlook for the fourth quarter is mid to high single digit same-store sales decline. Dick's is also looking to expedite the turnaround there, which means offloading old inventory, steep markdowns in that fourth quarter, which is going to really hurt the margin as well. So Foot Locker, needs a lot of work. Fourth quarter is going to be weak, and investors are really looking to see how quickly they can turn that business around.
Yeah, and probably they'll need to put some money into it as well to reorganize stores and freshen up the display. How much of this deal, Dick's buying Foot Locker, was predicated on Nike and what it was doing with this shift back to its wholesale channels and away from solely relying on its direct-to-consumer offerings and its own stores?
So Foot Locker was, I would argue, overexposed to Nike, several years ago. They had been working that exposure down. I think Dick's will remain focused on being diversified, just given that their own assortment, where they're leaning into lots of other brands, new up-and-coming brands like Hoka and On. They did discuss, though, that Foot Locker will sort of remain sort of a hub for basketball, and Nike does have a strong hold in the basketball market. So I expect Nike to be, a strong vendor with Foot Locker, but Dick's is looking to make sure that they have that right assortment, the newest stuff, the hottest lines coming from Nike and others.
What is Dick's saying about tariffs in their business?
So, they are going to feel higher costs, in this back half of the year and even into next year. Dick's has, since the pandemic, since they've been able to see sort of an increase in demand for their premium assortment, they're not really a huge discounter for the holiday. They like to sell their product fully through. So I don't expect them to sort of discount, and they have taken prices up selectively, but certainly not across the board. And their higher income consumer is sort of accepting those increases. I think Foot Locker is a little bit of a different story. And you might see that impact a little bit bigger on that business just because they don't have those premium products, and they're already going to need to offload older inventory with steep discounts. So you sort of have that turnaround compounded with these rising costs heading into the next year. So something for them to work on.
Lindsay, I also want to ask you about Best Buy. The shares are up about 4.5% right now. And of course, this consumer electronics retailer had a beat and raise quarter. It looks pretty good, and it looks like it's on the usual strengths, sales of mobile phones and sales of computer equipment.
Yeah, so Best Buy had a strong third quarter, better than expected, as you mentioned. I think, the stock isn't getting a full bump because there is definitely some conservatism and a low guide for the fourth quarter. And investors are trying to figure out, is it just conservatism? Are they just worried about the consumer? Or is there something really there that there's going to be a slowdown in that fourth quarter? But the business looks good. Demand looks strong. As you mentioned, computing, phones, gaming, all looking solid. And they're also seeing an improvement in home theater, which is really big because that has been a weaker category for the last couple of years. So if that comes to fruition, I definitely think there will be strength in the fourth quarter.
So you think about a Best Buy, I mean, some of those are big ticket items here, and that would suggest that they're confident. They go to a part of the K-shaped economy maybe that is doing better. Is that a typical Best Buy customer?
So Best Buy, definitely promotions are going to be a big piece of the fourth quarter. They're sort of leaning into those promotional events. That's what worked last year. And I think they're trying to lean into the things that worked last year for this year. And I do think the consumer backdrop is quite similar when we do that compare. They also recently launched a marketplace, and they seem to have a stronger focus on marketing and advertising. And so they're really trying to meet the consumer where they are and make sure that Best Buy is top of mind when you're shopping for a wide array of things, not just those big ticket items like TVs or appliances. So they're trying to have a bigger wallet share with consumers across the board, and they're leaning on that marketplace and advertising to do it, and then hopefully get you into the store, and that's where they can bring their customer service and experience as well.
Did they say anything or give any indication on how they're preparing for Black Friday and for the holiday shopping season?
It sounds like very similar to last year. So they started their deals about a week ago. They roll out new deals each week. They are leaning into their paid membership program. So paid members get access to certain deals over the regular shopper. But the playbook looks very, very similar, but the demand picture looks better. So hopefully those promo events can really draw that shopper in, especially since everyone's already looking for those items.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's dig into some of the individual companies a little bit more here with Mary Ross Gilbert. She's a senior equity analyst covering the sector for Bloomberg Intelligence. And Mary, let me start off with Kohl's, because we talk about companies that are gaining market share. Kohl's lost a lot of market share over the past 5-6 years, and it's coming back a bit here. What is its strategy? Is it just that it's kind of simplified its business model?
Scarlet, what's happening here is that they've kind of gone back to the basics. What's something that Kohl's has always been known for. So one is their private brands. So if you think about some of the brands like So and Juniors, Lauren Conrad for women, and they brought those brands back because they actually sacrificed some of those brands under the prior leadership and replaced them with some more name brands like Madden Girl, trying to really attract the junior shopper there. And now that they brought the private brands back, they brought back petite sizing, which was really important to their customer base. Now they're really starting to see, a recovery. But they're not out of the woods yet, Scarlett, as you pointed out. I mean, they're really cycling 3 years of declines. But we are seeing encouraging results. And given that they actually turned positive in the latest month, it looks like they could actually reach break even in the fourth quarter, even though they're guiding to a 1.7% comp sales decline. So it's very encouraging to see with Kohl's. Again, not out of the woods. And when you look at what's going on with Sephora, it's now a $2 billion business. And as you were sort of highlighting, that means they really lost, over the last 4 years, something like $4 to $5 billion in other categories. So they have lost market share. We think they're losing it to off price and some of the value players in the specialty space, such as Old Navy, a Gap brand.
Stock is up 33% today alone, which is a huge move, up 49% year to date. So it seems like the market likes what it heard here. So from a competitive landscape, where does Kohl's kind of fit in out there, Mary?
So, Paul, Kohl's is really a value player in the department store space. So they're really a notch below Macy's, and they're also located off the mall, which can be an advantage. And because they brought in Sephora as a beauty authority, and beauty is a very big and important and higher margin category for department stores. So that's, sorry?
You have to invest in your face, somebody once told me.
Yes, you got to invest in your face. That's exactly right. Well, the idea there is that you're getting a repeat customer. They have to come back and they have to replenish product. But we did see a comp sales decline because as that business has matured, it's kind of tracking somewhat close to what the company is tracking in terms of comp sales. So we did see a decline in the latest quarter. So they do have a number of initiatives to try to bolster that. Because, of course, we're seeing gains with some of their competitors, and we think we'll see that when Macy's goes to report next week.
Right. And of course, that's a big one, right? In terms of department store chains, we'll be looking for that one. And of course, you'll help us break it down when those cross. Mary, I also want to ask you about Abercrombie & Fitch. It was the darling 2 years ago because the new CEO found a way to make the brand relevant to a new audience. It was no longer targeting teenage boys, for instance, and really targeting young working women. But it's had a brutal 2025. The shares have fallen, I believe, more than 50% through Monday's close. A lot of concerns about tariffs, perhaps, and maybe even a lack of fresh ideas in terms of its offerings. When you look at the stock today, it is soaring up 30% on the latest earnings. What's the narrative with Abercrombie & Fitch right now?
Yeah, so Scarlet, with Abercrombie & Fitch, their numbers came in better than expected. So the namesake brand, as you pointed out, I mean, that had been double-digit increases over the last 3 years. So they're cycling those increases. And that's why their sales are coming in less than expected generally for the whole year and why the stock is down. But this quarter, the comp sales decline there was about 3.3%. So that was better than expected. And when you look at Hollister, though, Hollister has been coming in ahead of expectations and they've been posting double-digit increases. So as you were talking about sort of the millennial women who really love, and also the men, but it does tend to favor more of the women on the Abercrombie side, on the Hollister side, which really caters to Gen Z, that has been on fire. And so that's what's helping to kind of overcome the weakness that they're seeing at Abercrombie. But also, it's looking like Abercrombie could turn positive in the fourth quarter with a number of the initiatives that they have in place going into the holiday quarter, even though they're cycling some pretty strong gains in the prior year and the year before that. So there's some encouragement there. And I think, and then, of course, you have some short interest both in that stock and also in Kohl's. And that's part of the big bounce back that you're seeing this morning is some of that short covering.
What we're not really talking about, Mary, is tariffs and the impact on these retailers. What's the story these days?
Yeah, so in the case of Paul, in the case of tariffs with Abercrombie, they expect to have a $60 million hit in the fourth quarter. So they are being hit by tariffs, but they're discounting less. Plus, they have lower freight expenses. And this is something we've been hearing from most of the retailers is that lower freight costs are also helping to bolster margin. So they are going to be impacted, but probably not as badly as before, given that they've got an improvement in average price points, less discounting, and lower freight. That's helping to offset some of the tariffs. And remember that $60 million hit on tariffs for Abercrombie? That's after mitigation efforts. So there is still going to be an impact. Kohl's even brought it up, which they hadn't really brought up tariffs in their prior two calls, but they did say that going into early 2026, there will be some impact there for them. And the reason why their margins have been holding up and coming in better than expected, and their margins are low, but it's because of the fact that their mix of business being more private label, which is higher margin, is helping to bolster those margins.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
JM Smucker Company, SJM is the ticker symbol. They are in Orrville, Ohio. Stock is trading right at $100 a share. It's down 3% today, down 8% year to date. It's got a market cap of about $11 billion. I don't look at that company too often here, but they reported numbers. They lowered the top end of their full-year guidance after the company opted to forego a planned price increase on coffee in the wake of tariff relief from the Trump administration. Let's get the latest on this name and on some of the other food companies. Diana Rosero-Pena, consumer staples analyst for Bloomberg Intelligence, joining us live here in our Bloomberg Interactive studio, all the way from the 10th floor?
From the 10th floor.
Boy, that's a long walk now, because you guys used to be just one floor away. We could just stomp on the floor and you guys come running up to help us out. Okay, talk to us about JM Smuckers. This is jelly. This is coffee maker. Smuckers. What's going on there?
Pet food as well. You know, pet snacks and cat food. So basically, I mean, it was all right. There were some puts and takes for the quarter. There's some signs of stabilization, but it doesn't seem that it's there yet. It's similar to other packaged food companies that we're seeing in the space. It's always a second half or the next 6 month story when it's going to get, growth is going to happen. And it really doesn't happen. So, people are starting to lose patience on that.
So specifically as it relates to the tariffs, they, like a lot of your companies, they're just telling you what the number is.
Yes.
So what's their tariff cost, I guess, for the period?
Yeah. So right now they're saying that for fiscal 2026, it's going to be about $75 million, even excluding that tariff relief that they are experiencing, which is, the reason why they're not going to increase prices for the third time this year.
So they have been raising prices on coffee?
They have been raising prices on coffee. This is a category that is very pass-through category for Smucker. The problem with that is that competitiveness is a little bit, declining compared to private label. So they're trying to, forego some of the margin, recoup to be able to be more competitive.
Is that what most of the companies are doing, the packaged goods companies? Are they trying to take as much as they can in their margin and then pass the rest along to consumers?
Well, it depends on the category. Okay. For coffee, this is definitely normal for them. They tend to be also a category leader, so it kind of, they tend to say what the prices are going to be. But some of the other packaged food companies that we have seen, they take some margin hit. They try to or not putting that on the consumer because they have been increasing prices for the past couple of years. So they already think that elasticity is getting there.
Right. So what are these companies like Smuckers, what are they saying about the consumer out there? How's the consumer? Are they switching down? Are they more price sensitive than usual and maybe switching to store brands? Yes.
So we're seeing a private label to get some market share in the past 6 to 8 months. And that obviously has been a headwind for packaged food companies. They're becoming more competitive, not necessarily Smucker, but, we're seeing others such as Campbell's and the like saying that they're going to be more price competitive in 2026. So we should probably experience a little bit more of, muted sales growth and margin contraction.
So you also follow CW, the Post company, right?
Yes.
Just remind me about their products. I mean, that's primarily cereal?
That's primarily cereal. They also bought their pet, category from Smucker. That has not done so well. And they also have some of the, like eggs product, side dishes and the like. And that has been a little bit on the upswing because, again, that's another commodity that they can pass through price increases, and they have experienced that, and they have been able to offset some of the declines from cereal and even pet food.
So if you're doing coffee or even cocoa, that's just a commodity. Yes. And those prices have been going up because there's been droughts in some of the coffee growing places and cocoa growing places around the world. So if you're Smucker's, you just pass it along, right? I mean, it's just, if your commodity costs are going up, you just got to pass that along. Right?
Yes, and that is obviously exactly what they're doing.
When coffee comes down, do they cut the price up?
Yes, they actually do, which is, they anticipate or they hope that, price increases stop so they can actually become more competitive. But we'll see. It's a second half of the year story now.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.